any of those photos brought back memories from your childhood, then congratulations. You are probably a millennial and are
super cool. Oh yeah.
And even if you're not a millennial, as long as you're planning on buying a home at some point in your life, then make sure to stick around because you might learn something new from this video. Today's video is part 2 of the home buying series, which is going to focus on all the different types of expenses that are associated with buying a home. In the previous video, I used this cool rug from the 90s to help visualize the 4 different stages people will go through prior to actually closing on a home. We focused on the buying preparation category and helped give you a better idea as to whether or not it's the right time to buy a home right now. And in this video, our goal is to introduce question number 2, which is how much house can I afford? But prior to diving into all these numbers, first I think we need to talk about what expenses should I anticipate when buying a home. So as a millennial, you and your family have been holding on to all your stimmy paychecks and getting ready to buy the first house you see that has mahogany flooring and granite countertops, right? Not so fast. Since we are looking to buy a home, then we need to take in consideration all the different costs that are associated with taking out a mortgage. For example, let's compare renting versus buying a home. With renting, the only payment you really need to worry about is paying your rent on time each month. However, taking out a mortgage is a little bit different. Not only are you required to make your monthly mortgage payment on time each month, but there are also additional expenses that you need to account for, such as a maintenance expense. As a new homeowner, you no longer have the luxury of reaching out to your landlord anytime something breaks in your apartment. You are the landlord, so paying for repairs is something you need to account for prior to taking out a mortgage. Some more expenses you need to consider are property taxes, homeowners insurance, and private mortgage insurance. So usually when you make your monthly mortgage payment to your mortgage lender, a majority of your payment will go towards paying off your mortgage. And then there's a portion that goes towards your other homeowner obligations, such as these 3 things. And if this sounds confusing, don't worry, I made a video after this one which explains how all these numbers tie out in Microsoft Excel. But for now, I just want to give you a better understanding of what all these different terms mean. So as a new homeowner, your property taxes will be calculated by multiplying the value of your home by your local government's tax rate. Meaning if your local tax rate was 1.09% and your home was valued at $100,000, then you would pay $1,090 per year to your local government for property taxes. This amount is usually added on top of your monthly mortgage payment and is put into an escrow account by your mortgage lender. Think of an escrow account as a third-party holding area where your lender takes a portion of your mortgage payment and sets it aside in this account so they're able to make insurance and tax payments when they are due. And the same thing applies for your homeowner's insurance. Think of this as financial coverage for your home in the event that your house burns down unexpectedly. Most banks and mortgage lenders will require you to have this type of insurance as they are trying to make sure they are protecting their investment. After all, if you're not able to make your monthly mortgage payments, the lender has the right to foreclose on your home to try to recoup the original money they lent to you from the mortgage. And so similar to the property taxes example from earlier, if your annual premium for homeowners insurance is $1,312, then that means $109 will be added on top of your mortgage payment each month, and then that amount will be set aside in escrow to be paid by your mortgage lender. So you can see how quickly your mortgage payment can add up in comparison to renting an apartment instead. And of course, there's still one more type of insurance that's gonna affect our monthly mortgage payments, and that's private mortgage insurance. So this type of insurance will most likely be added to your monthly mortgage payment if you ended up putting a down payment of less than 20% down on your house. And I know we haven't talked about down payments yet, but yes, if you are looking to buy a home, then you should expect to pay a significant amount of money up front prior to closing on a home. A mortgage lender or bank will often look at your down payment as your investment in your home. And usually the more money you put towards your down payment, the lower the interest rate will be on your mortgage. So if you're interested in living in a home that's priced at $200,000, then your goal should be to save up $40,000 so you can afford the down payment. Now, of course, if you can't afford the $40,000 down payment, there are other options for getting a mortgage that require $0 down, which I'll talk about in another video. But usually, if you're getting a conventional mortgage and are putting less than 20% down, then not only will your interest rates be higher, but you'll also most likely be required to pay for private mortgage insurance every month. So as I was telling you earlier, PMI is going to be added to your monthly mortgage payment if you end up making a down payment of less than 20% on your home. And the way this works is your bank or mortgage lender has determined that in the event that you're not able to make your monthly mortgage payments each month, then they will have to sell your home in order to recoup a portion of the money they lent to you. During this foreclosure process, the lender has determined that they should be able to recover 80% of the home's value. So since they're not able to recoup all 100% of the money they originally lent to you, then that remaining 20% needs to be covered by insurance, and that's an extra expense that they will require you to pay for. So that's why it's recommended that you make a down payment of at least 20% of the home's price. That way, you not only get more favorable borrowing terms on your mortgage, but you also won't be burdened with having to pay extra for PMI every month. And so when we compare buying versus renting, we can see there's definitely a lot more expenses we need to take in consideration when we are looking to buy a home. And before we dive into Microsoft Excel and I show you an example of how you can calculate how much house you can afford, I just want to touch on a few more expenses that we need to consider prior to buying a home. First off, let's talk about closing costs. So there are a lot of miscellaneous expenses involved when trying to buy a home. You'll have to apply for a mortgage from a bank, and then someone is going to have to process your paperwork and determine how much money they're willing to lend you. You're also going to have to get the home appraised. And you can see there's a list of miscellaneous expenses that you have to pay for just to finalize a mortgage. But keeping this short, you should expect to pay between 2 and 5% of the loan amount in closing costs. And this can be paid by either having it financed in with your mortgage, paying the one-time expense out of pocket, or negotiating with the seller to pay a portion of the closing costs. Regardless of how you pay, closing costs are going to be an inevitable expense you'll have to anticipate when looking to buy a home. Another home ownership expense you need to consider prior to buying a home are HOA fees. A home ownership association, or HOA, is basically a self-governing community of people living in the same area. They agree to obey the rules of the community to keep everyone safe and usually enjoy shared amenities like having a swimming pool or a gym to work out in.
Oh yeah.
If you're the type of person that enjoys not having to upkeep your home, then you would probably enjoy living in an HOA. Usually each month you'll pay an HOA fee, which gets used to help cover maintenance expenses, staffing, and amenities in the community. You should expect to pay around $200 per month to live in one of these communities. But just remember that $200 can vary depending on where you're living and how many amenities your HOA offers. So just keep that in mind if you are looking to buy a home in an HOA community. Wow, the whole process of buying a home seems like a giant headache. All these expenses are really adding up and making it seem like taking out a mortgage will be impossible for us millennials. Not so fast. There are tax benefits for having a mortgage. For example, as long as you bought your house after December 15th, 2017, then you're eligible to deduct your interest payments on the first $750,000 of your mortgage. Meaning if you bought a house at the end of 2017 and your mortgage was $400,000 and in 2020 you paid over $12,000 in interest on your loan, then you would be eligible to deduct over $12,000 in mortgage interest on your tax return. So despite having all these expenses associated with taking out a mortgage, you are able to save a little bit on your tax bill each year just by paying your mortgage interest on your loan. And so to revisit one of the original questions of this video, how much house can I afford? We're gonna have to wait until part 3 of this video comes out, where Barbara Corcoran and Dave Ramsey are gonna duke it out to see who has the best strategy when it comes to calculating how much house you can afford. See you next time, and as always, stay frugal, fam. Hey guys, I just wanted to thank you for watching this video. Be sure to hit the subscribe button that's right above me. And then check out my other videos, which will be listed on this side of your screen. We'll see you next time, Frugal Fam.